Welcome to week 3. We'll be covering debt and credit in this week's class. Firstly, we're going to be looking at debt investments. So the most typical debt investment is a corporate bond or a government bond. So what are the features of a bond? Hopefully you'll recall from your introductory classes that a bond is a promise to pay a fixed amount of interest on a periodic basis to the holder of the bond and to repay the fixed amount of principal at the date of maturity. So when we're looking at bond markets, one of the ways that we tend to divide the market up is that we look at the maturity of when the bonds are going to be mature. So money market are short-term issues, so they mature in less than 1 year. Notes are intermediate issues, so these are between 1 and 10 years. And bonds tend to be long-term obligations with maturities of greater than 10 years. What's important to note, and we'll look at this later in the class, when we're looking at the formula, it becomes apparent. The longer the maturity of a bond, the greater the price volatility. And when we cover the formulas, this will become apparent why. Key thing to understand with bonds is that a bond is merely a contract between an issuer and an investor, whereby the issuer agrees to make specific payments at specific times. These payments may be a specified dollar amount, perhaps expressed as a coupon rate multiplied by the par value, the issue value, or they could be floating rates, so the rate might be based on a margin above a particular reference rate. Now obviously bonds, just like shares, can be traded amongst investors. That's going to be the secondary market, obviously, when they're trading between investors. Primary market is obviously when the company issues the bonds in the first place. Now what many of you may not realise is that actually the bond market is much larger than the share market, but this is not as visible and not reported as frequently in the news. One of the key reasons that bond markets are so large is because not only are there corporate bonds, but there's government bonds, and obviously a lot of pension funds particularly and retirees like to invest in very low risk securities that provide a regular income stream, and so bond markets meet these specifications. So what are some bond characteristics? Well, for most bonds we have a coupon, and so that's the regular payment of interest. Note that there are some bonds which do not pay interest, and these are usually called zero coupon bonds. The maturity is when they have to repay the principal. That's the term. So how long has the company borrowed this money for, or how long until the investor gets repaid their principal. The principal is obviously the initial amount that is raised for each bond. This is often called the par value. And note that some bonds are issued with a call option, and so the option is for the issuer to repurchase the bond, which they'll likely do, which they'll likely exercise if interest rates fall, because in that instance they'll be able to reissue new bonds at a lower cost. In this course we're not going to be covering the features of call options other than to mention it a few times. So what are the types of issues? Well, you can issue debt which can be senior and secured. So it ranks very highly in terms of liquidation, and it's also secured by assets. Kind of the next rung down is senior and unsecured. So it ranks highly, but it's not secured by any specific assets. And then you've got subordinated debt, which tends to be ranking below the senior debt, and so obviously would be less secure and require a greater yield to compensate for that greater risk. Who are the issuers? So who raises money via this? So government agencies. So in Queensland, for example, we still have a number of large electricity companies which are owned by governments. So they'll often issue debt. Corporations. And corporations will often issue different types of debt. So they could be asset-backed securities. So the banks, for example, might spin out some of the mortgages that they own and securitize the mortgages so that it's an asset-backed security. They might use floating rate notes. They could use coupon bonds. So there's a whole host of different ways that governments and corporations can issue bonds. So in terms of a bond, how do we value a bond? So a bond is simply a promise to make cash flows in the future. So in order to find the value of the bond, we simply take the present value of its future cash flows. What are the future cash flows? Well, the future cash flows are the coupon payments, which we refer to in the formula here as C. And depending on the maturity, from T beginning at 1 up to the nth period, N being when the bond matures, we'll receive coupon payments at each of those periods. At maturity, so at N, we'll also receive the par value or the principal back, and so we have to discount that principal payment back as well. Now note, usually the coupons are paid at a regular period, and so usually we can simplify the present value formula to an annuity, a present value annuity of the coupons, plus the present value of the principal or par value. Now note, if we talk about price and yield, we can see that in this formula, if the interest rate goes up, then the price of the bond will clearly fall. Whereas if our discount rate goes down, the price of the bond will increase. And so this is what we call the price-yield relationship. So you can see in the right-hand graph that as the yield to maturity increases, the price of the bond will fall. And if the interest rate decreases, then the price of the bond will increase. And you'll note that there's two lines here. There's the blue line and the black line. So the blue line, which is the curved line, that, as you can see, is a non-linear relationship. In fact, it is a convex relationship. So the actual relationship between the price of a bond and the yield on the bond is convex, such that a decrease in interest rates has a bigger impact on prices than an increase in interest rates. So for 1% decrease in rates, we have a greater increase in price to what we'd have if we had a 1% increase in rates. So, and then you can obviously see that in the graph to the right. So, if we, just to get some terminology so that it's easier to understand these concepts, the coupon rate is the rate that the issuer promises to pay in terms of each coupon payment. And so it's a coupon rate relative to the par value. So if you take the coupon payment divided by the par value, you get the coupon rate. Or if you multiply the coupon rate by the par value, you will get the coupon payment. The yield to maturity, on the other hand, is the return which the bond investor will earn. However, three outcomes must be realised for them to earn this yield to maturity. First and foremost, we assume that the issuer makes all of the payments and there are no defaults. Secondly, we assume that the investor can reinvest all of the coupon payments at the same yield to maturity over the holding period. And thirdly, we assume that the investor holds the bond until maturity, or if the investor sells before maturity, we assume that interest rates haven't changed, so the sale price reflects the same yield as when the bond was purchased. Now, if we look at the yield to maturity relative to the coupon rate, we can identify whether or not a bond will be priced higher or lower than its par value. So if the yield on a bond is less than the coupon rate, that must mean that the bond will be priced at a premium to its par value. That is, the amount of interest it's receiving in terms of those coupon rates are higher than what the market is expecting for debt of that quality in the marketplace. So you can think of that yield as the market price for the risk of a particular bond. And so if the coupons are higher than that, then the bond will sell at a premium higher than its par value. On the other hand, if the yield is greater than the coupon rate, then the bond will be priced at a discount to its par value. And you can work that out quite simply by doing some examples, looking at the formula on the bonds again. And you can see that when the coupon rate is higher than the yield to maturity, or the cost of debt, the R in the formula, you'll see that relationship come out. Another important implication, as we discussed on the last slide, is that the price to yield relationship is not a straight line, it's a convex line, and we'll talk about this in a little bit more detail in the next couple of videos. The yield to maturity can be used to compare different bonds. So if we have bonds which are similar in credit quality to other bonds, then we can look at the yield of those other bonds to figure out what the yield should be on new bonds which are being issued. And so then we can figure out, okay, what will we pay for these new bonds? We can also infer the yield to maturity on bonds which are trading in the marketplace by looking at what they trade for, the price at which the bonds are trading. Given that we know the time to maturity, the coupon payments, and the par value, we can then figure out what's that internal rate of return. And so that's the yield to maturity. The current yield is the coupon payment relative to the market price. So that's similar to a dividend yield on shares. So that is different to, importantly, the current yield is different to the yield to maturity.